97.2%. I mean, just let that number sink in for a second. That is the staggering, eye-popping percentage of recent market liquidations that were short positions. We're talking about an absolute rapid-fire decimation of the market bears. A massive squeeze is underway right now, forcing traders to just scramble and cover their positions as the market surges against them in this incredibly high-stakes, adrenaline-fueled battle for control. Okay, let's dive into this. Welcome to The Explainer. Today, we are looking at the vibrant, explosive battleground of the cryptocurrency market as it stood on July 15, 2026. What we're witnessing here is a massive convergence of events driving a powerful relief rally, with Bitcoin mounting a direct assault to reclaim that critical psychological level of $65,000. So let's break down the forces that are actually driving this incredible price action. Section 1, the macro relief rally, where opposing forces collide. To really understand the crypto charts today, you kind of have to picture the macroeconomic landscape as this clash of absolute elemental titans. We have massive top-down monetary pressures meeting volatile global events head-on. The very first major strike in this battle, a massive surprise reading of minus 0.4% in the June U.S. Consumer Price Index. That is the lowest annual increase we've seen since way back in early 2020. This sudden, sharp cooling of inflation completely shifted the momentum on the battlefield. I mean, before this data dropped, the odds of a Federal Reserve rate hike at the upcoming July 29 FOMC meeting sat at 31%. In a flash, as the market digested this cooling data, traders slashed those rate hike odds down to just 14%. And this brilliantly illustrates the dynamic tension we're seeing. On one side, we have incredible bullish momentum stemming from that cooling U.S. inflation data, raising hopes for a dovish, crypto-friendly Federal Reserve. But colliding directly against that, we have the fragile, volatile resistance of global geopolitics. Tensions between the U.S. and Iran, including a maritime blockade, had threatened to spike crude oil prices, which, as we know, acts as a massive inflationary headwind. However, the unexpected cancellation of planned Strait of Hormuz transit fees actually forced oil prices to retreat. That retreat basically neutralized the immediate inflationary energy threat, providing the exact window of opportunity that risk assets like Bitcoin needed to just surge forward. Section 2, Reinforcements, the ETF inflow rebound. Just when the market floor looks like it was literally about to give way under the pressure of recent weeks, heavy institutional reinforcements arrived on the scene to hold the line. Look at this number, $239.4 million. The market had been suffering through a really brutal period of selling, including an 8-week streak of heavy institutional outflows that drained billions. But on July 14, U.S. spot crypto ETFs saw a sharp, sudden reversal, pulling in over $239 million in net inflows. This was an absolutely critical lifeline of capital stepping in to stabilize the floor. Let's see how this builds and who is actually leading this charge. BlackRock is stepping up as the heavy artillery for the market bulls here. Their IBIT Bitcoin fund single-handedly captured $138.9 million in additions. Their Ether fund, that secured another $58.3 million. Meanwhile, the rest of the market saw minor or zero flows. This tells us a fascinating story, right? The institutional reinforcements have absolutely arrived, but they're highly concentrated. BlackRock is almost entirely anchoring this specific wave of demand. Section 3. The casualties. The meme token crash. Now, as we all know, every massive market move leaves some collateral damage in its wake. So let's slow down the pace for a quick second and survey the decentralized battlegrounds. While Bitcoin was pushing higher, a specific sector of the crypto ecosystem took a really violent hit. The Noxa platform, which is a major launchpad for meme coins, suddenly disabled new token launches and abruptly altered its fee structure to route 100% of fees to creators. This single, centralized decision sparked a rapid, sector-wide panic. Major platform tokens felt the immediate sting. Cashcat crashed 10%, while Juggernaut dumped a brutal 18%. So the crucial takeaway here is that while the broader market enjoyed a macro relief rally, this dramatic fallout violently reminded traders of the deep systemic risks associated with centralized governance inside supposedly decentralized ecosystems. Section 4. The disconnect. Squeezed shorts and extreme fear. Now, what's really interesting about this slide is the massive, glaring paradox in today's market structure. It's a sheer contradiction between price action and human psychology. Bitcoin has violently reclaimed the $65,000 level, painting a beautiful green rally on the charts. Yet, look at the sentiment dial. The crypto fear and greed index is sitting totally paralyzed at a score of 21. That is deep, deep in the extreme fear zone. Retail investors are essentially frozen. The soaring price action is completely disconnected from the terrified sentiment on the ground. To the average retail trader, this looks like a trap, like a temporary relief rally, rather than the confirmed start of a new bull market. And this quote right here perfectly diagnoses why that disconnect exists. The combination of extreme fear sentiment with rising open interest and heavy short liquidations creates a technically fragile setup. Because retail investors aren't stepping in with pure spot demand, this rally is heavily artificially fueled. Remember those 97% short liquidations we highlighted at the very beginning of the explainer? That is forced buying. It's mechanics, not pure conviction, making the market's current foundation technically favorable for sure, but highly, highly fragile. Looking at the historical mapping of systemic leverage ratios, we can clearly see how these liquidation cascades operate over time. When leverage builds up to extreme heights, any sudden price move triggers a cascade of forced liquidations, basically wiping out the overexposed and rapidly resetting the board. The massive short squeeze we are analyzing today fits perfectly into this broader, historical cycle of leverage buildup and violent release. Section 5, the final boss, the 65K make or break zone. Which brings us to the ultimate showdown of the day. The tension is absolutely peaking as Bitcoin approaches its most critical technical resistance layer. For Bitcoin to convert this fragile, squeeze-driven bounce into a genuine, confirmed trend reversal, it has to execute a very tactical, step-by-step path. Step 1. The bulls must fiercely hold the $62,000 to $64,000 support zone as their base of operations. Step 2 is the critical strike. They have to clear the 50-day exponential moving average, which sits like a fortress wall right at the $65,150 to $65,600 zone. If and only if they can pierce that technical armor, Step 3 finally opens up and advance toward the massive $67,000 to $70,000 supply cluster. But actually, remember, this battlefield is entirely dynamic, and massive new variables are about to enter the fray. We have two huge incoming macro catalysts on deck for today. The U.S. Producer Price Index report is imminent, and Federal Reserve Chair Kevin Warsh is preparing to deliver his testimony to the Senate Banking Committee. These two events will inject a fresh wave of volatility and will heavily influence the market's expectations for future interest rates. So what does this all mean for us? What you absolutely need to take away from this explainer is that we are hanging on a monumental cliffhanger. Can the bullish forces harness this macro momentum, fight through the extreme retail fear, and shatter that 50-day EMA resistance? Or will the highly concentrated ETF reinforcements simply run out of ammo, leaving the market to slide back down? Keep your eyes locked on the charts, because this high-stakes showdown is just getting started.